One of the questions that I get asked a lot on my channel is, how does tax work with trading and how much tax do we have to pay? Although this could seem like a boring topic to some of you, it is still essential to come to grips with as a trader. So in this video, I'm going to be talking about paying tax as a trader. But first, before we dive into the main content, I have to clarify some points with you. I am not a financial advisor and I am not a registered accountant. So if you are truly stuck when it comes to the topic of paying tax as a trader, the first step is always to seek advice from a registered accountant or a qualified financial advisor. In this video, these are some points that I have gathered together based on years of experience as a trader, years of experience managing books and processing accounts, as well as hours of research on the specific topic. I have included some links to resources that I share in this video in the description below, so make sure you check those out. Another crucial point to remember is that I am based here in the UK, so everything I'm talking about in this video is going to be focused towards being in the UK. And if you're watching this video and you're wondering just who are you, my name is Emily, and on Mindflow Trading, I share my journey as I grow and develop as a trader. I originally started trading about 5 years ago, trading the US stock market. Since then, I've gravitated towards day trading the foreign exchange market, or Forex. As well as trading my own personal account, I also trade with a prop firm called the 5%ers. If you're not sure what a prop firm is, I have created a separate video that talks a little bit more about prop firm. It is a great avenue to take with your trading if you are struggling with capital to make money on from trading. And it's basically where you work with a company and you trade their company account, but you take a split of any profits that are made. It can be a way to make a living as a trader if you don't have any money up front to start yourself. And personally, I find the 5%ers to be one of the best prop firms out there because they have fair rules and they have realistic targets, as well as tons of support. So if you want any more information on the 5%ers themselves, I have got a link in the description below with the resources from today's video. Moving on, let's get into the main content. Before we focus on the topic of trading itself, let's firstly clarify the three main areas of tax. Income tax is the method of paying tax that most of you will probably be familiar with. Whether employed or self-employed, income tax is the common method of paying tax on any money that you earn. We all have a tax-free allowance which changes each tax year. So for the current tax year that we've just entered into, which runs from April 2023 to April 2024, the current tax-free personal allowance is £12,570. Capital gains tax is the tax on a profit when you sell an asset that has increased in value. So we each have a tax-free allowance again for capital gains tax, which is currently set at £6,000. So for example, if we sell an asset and we make £6,000, that will come under the tax-free allowance for that current tax year, and you won't need to pay tax on that £6,000. But any additional income made above the £6,000 is taxable through capital gains tax. Finally, we have corporation tax, which is similar to income tax, but corporation tax is payable to companies. Corporation tax is the main tax that a limited company has to pay. It is paid on both the company's profits and also any profits from selling any company assets. There are other areas of payable tax, such as stamp duty tax, which is applicable if you are buying and selling property. But in this video, I'm going to keep it focused and orchestrated around tax relating to trading. But how does any of this relate to trading? Well, this is where it can get a little bit confusing, as there are quite a few points to consider when it comes to paying tax as a trader, and there is no clear or obvious answer. That's why if you are not sure what to do for your specific situation, I always recommend seeking advice from a registered accountant, as they will be the most up-to-date with the most recent legislation. Firstly, let's address one of the most obvious points of earning profits as a trader, and that is trading with a prop firm. Again, this is where you are trading with a prop firm's company capital and taking a share of any profits that are earned, as I currently am with the prop firm, the 5%ers. Through this method of trading and paying tax, more often than not, you'll be classed as a subcontractor, working on behalf of the company, and therefore tax is payable. This can be through paying income tax down the self-employed route. Alternatively, you can pay corporation tax if you open and register as a limited company. Within your company, you can then set yourself up as an employee and pay income tax this way, and then receive any extra capital through company dividends at the end of each tax year. This might sound a little bit confusing, but there are many benefits to this option, such as helping to avoid paying the higher threshold of tax if you are earning quite a lot of income as a trader. Paying tax in this way is a legal loophole. If you are trading the stock market, if you are trading stocks where you are buying, owning, and then selling an asset, meaning that you own that stock or share of the company, whether you own it for 5 minutes or for 5 months as a longer term position, you will still need to pay tax on any profits that are made. But as you have owned the asset, this will come under the category of paying capital gains tax. Usually when you complete your tax return at the end of the tax year, there is a separate section where you enter in the amount of money earned and taxable through capital gains tax. You can simply take your net figure earned, your winners minus your losers, and then add this onto your tax return, in addition to your usual process, adding any other income that has been made in that tax year. Usually, capital gains is 10% for a basic taxpayer and 20% if you are in the higher band of paying tax. There is a really useful calculator on the gov.uk website that can help you to calculate just how much capital gains tax you're likely to need to pay. Some brokers here in the UK, such as Trading 212, provide multiple account options. They provide CFD accounts, investment accounts, and ISA accounts, individual savings accounts, where you can then trade from. And this is a great way to trade or invest, is through an ISA account. If you are trading and investing from an ISA account, then you don't need to pay any tax on any profits made during that tax year. And each tax year, you can make an additional deposit of up to £20,000 into that ISA account. It can be a great way to trade or to invest, to be able to make some money, whether it is for long-term gain or whether you are looking to make a living. If you have some money to deposit into an ISA, it can be a really good way to trade and invest without having to pay tax. To find more about that account option and the markets that you are able to trade and invest with, I have got a link below to Trading 212, so make sure you check those out. Whereas for those of you who trade using a CFD account and trade Forex like me, here is what you need to know about paying tax in the UK. Although CFDs are free from paying stamp duty, you will need to pay capital gains tax on any profits made in your account that are over the yearly allowance. You can do this in 2 ways. One is by paying capital gains tax through your tax return each year. Alternatively, if you have set up as a limited company and it is your limited company that has made the profits, you can pay corporation tax. Now we've looked at a few different options of paying tax depending on what sort of account you decide to trade or invest from. Let's have a look at one of the most talked about topics when it comes to trading and tax, and that is, do you need to pay tax when you spread bet? Some people believe that you don't need to pay tax as it is classed as gambling. And this can be true for the odd win. There are trading accounts out there that lend themselves to this style of trading, where you can potentially avoid paying tax altogether, and these are called spread betting accounts. But if you are a professional trader who follows a trading plan and makes consistent profits, you will need to declare these, and most likely you will need to pay tax. Again, if this applies to you and you're still not sure, it is quite a confusing topic, and it's why it's always good to seek help and advice from a registered accountant or a financial advisor. Finally, to conclude, although I'm not a registered accountant or a financial advisor, I hope that this video has given you some answers, or at least some clarity when it comes to the topic of paying tax as a trader in the UK. It can be confusing and it can be tempting to try to avoid paying tax. But in my experience, if you make consistent earnings, then you will most likely need to pay tax. And it's just not worth getting into trouble over. If you're still not sure, play it safe with a registered accountant so that you have a better idea of what you're going to owe and when. Meanwhile, I have included links to all the resources I've talked about in today's video in the description below, so make sure you check those out. If you've enjoyed this video, if it's helped to give you some more clarity, some answers, then please help me out in return by hitting the like button, and make sure you subscribe to the channel below, and I'll catch you in my next video. Thanks for watching. Bye!